Hello everyone. Today I would like to share some family financial fundamentals learning with you. I'm using this baby toy because it represents the ideal family financial structure should look like. Let's get started. Let's say that this represents the market and your economy. And the first thing you need to do is to protect your family. Second thing you need to do is to make some savings. So the green ring represents your savings. Third thing you need to do is to manage your debt. Here I say manage your debt. I don't say get rid of your debt or don't have any debt, because debt has good debt and bad debt. We need to keep the good debt because it can generate some good cash flow and even have some tax benefits. We don't need bad debt because bad debt is an expense. It can damage your cash flow and get more troubles with you. So this, we say that good debt in your bucket. Then we can make some conservative investment, which means, this means low risk but lower return. Don't have too much expectations on the return. You will have this part, but you will protect your assets. Most of it, you will not have any trouble. The last thing above that, you can make some high risk investment, which we call it black swan event. So above of the fundamental settings, you can add a top of risky investment. So even the market is not stable, you are safe. Now let's look at what people do usually. Some people don't have normal expectations. They expect a high return and they want to spend a little bit money. When they have a little bit, they want a high return of investment. And if they're lucky, they can make it, but most of the time, they either run out of time or sometimes run out of even principles. And then they will downgrade it to the conservative investment to protect some money. Then if they have good luck, they might need money for life, a car, a house. Then they might need to take some debt in order to cover everything. And the thing is that if they are lucky, they can still make savings and they can still make protections. Here's the problem. The protections is the most difficult things to get once you get old or you are sick. So imagine if you're lucky, you are all good until you get someday you have everything good settings and things goes very well. If the market has a problem, your risky investment might have an influence on your settings. What happens? If you lose your risky, if the market is not stable, the first two things to be lost is the fundamental protection and your savings. And please remember, once these two things are gone, it's difficult to get them back. The savings needs time, the protections, even if you don't have good health, it's difficult to get a good rate for the insurance. When you are getting old, it's difficult to get it. So please be aware of these orders, and I hope I could explain well about the situation that most people are doing wrong is the order that they plan in their financial structure. We always need to put the protection first for their family, the health, life, and long-term care protection. Above that, you can make your savings, you can make the debt management, and then conservative investment, and the last, if you have extra money, do some risky investment, and that will make your financial structure very stable. And even the market is very unstable, you are safe. Okay, thank you for watching. Thank you. Bye.